If you're aiming to retire by 2040 and you are just investing in the Vanguard's popular VWRP or VWRL ETF and you are expecting to have a very good retirement pot, then you might be wrong, my dear friend, because diversification is the only free lunch in investing. And by the end of this video, you'll agree that you can comfortably retire in the next 15 years on your PAYE salary here in the UK by just following a simple method, and that is a well diversified 3 ETF strategy. By the way, if you're new to this channel, then let me tell you that I talk a lot about my all-time favorite 3 ETF strategy because I personally do follow this strategy and I've been investing for the last 15 years. Importantly, I've made a lot of mistakes and burnt my hands. I don't want you to make those mistakes, and that's the main reason for this channel. But before investing, let me tell you that please do consider these 4 key points. The point number 1 is your journey might be totally different than any other investor, so you're not copying each other. Point number 2 is this video is for educational purposes only. Point number 3 is this video is not at all about any financial advice. Point number 4 is when investing, your capital is always at risk. So if you're happy with those points, then we can start. So as far as this investment is concerned, I like to compare any investment project in 3 possible scenarios. Okay, even these could help you to advance your investment style or even to do a little bit more research on that. So I think an investment project in 3 possible scenarios, so just best case scenario, the worst case scenario, and the likely case scenario. And that's how I do my investment. So in order to diversify your portfolio a bit, if you would like to invest into a tech-based ETF as well as a dividend aristocrats or a all-world ETF, then how you can do your further analysis. So I've made a list of 3 possible tech-based ETFs. The IITU basically tracks the S&P 500 capped index, which is 35/20. Okay, and this is a standard index which is developed and maintained by S&P Dow Jones indices. And not a BlackRock in iShares. So this is actual index. Okay, so this is the ETF available. So this could be the best case scenario. Okay, so the second is worst case scenario. So the worst case scenario could be SMGB, which tracks the MVIS US listed semiconductor 10% capped ESG index, which is a market vector index company. Okay, so in the previous video I was talking about how an investment company such as these fund houses, they create their own artificially created benchmark, and this is the perfect example of that. So in the third column, I've kept XXTW, which is the X-Trackers MSCI World Infotech ETF. So this is basically a market index, and that is MSCI World Information Technology 20/35, which is similar to the previous scenario, which is IITU. Okay, and so this 20/35, that means they are giving a higher weightage to those largest companies, and that is 35% compared to the other companies, and that is 20%. But the thing is, this ETF is in the expensive side. So when we compare their expense ratio, the total expense ratio, then it is a bit higher compared to IITU's 0.15. So this scenario, in this case, this is 0.25. So this is a bit higher side. So this, we could think that this could be our likely case scenario, and this we can keep it on our side. So we can create this kind of our own analysis. Okay, so the best case scenario, worst case scenario, and the likely case scenario, and you can try and put those ETF ticker symbols, and then you can compare as I have explained in my previous video how I compare with 5 to 6 parameters, and you can do that analysis as well. So that we could do it in the second stage. So just in case if you want to allocate around 10 to 15% into a dividend based dividend yielding ETF, then you could think about some ETF. Again, you can follow the same principles: the best case scenario, the worst case scenario, and the likely case scenario. So regarding dividends are concerned, which I usually don't prefer, but if I were to think about any ETFs about this dividend, then VHYL comes in my mind. Again, this is a distributing ETF and yielding around 3%, which is their dividend payout ratio. If you're planning to retire in the next 20 years, then I would definitely go with VWRL ETF, which is the Vanguard's dividend distributing ETF. This VWRL has grown exponentially, and this is again a market index, so I would definitely think on that ETF. Okay, so in this analysis what we have done is we chose 3 ETFs. We have discussed about VHYL, and that is all about the best case scenario. The worst case scenario, that could be GGRP. Okay, so GGRP ETF, and that is the wisdom trees. That's the name of the fund house. Okay, and the global quality dividend growth ETF, that's the name of this ETF. Okay, and these basically tracking an artificial index. Okay, so the index name which they have given is the wisdom tree global developed quality dividend growth index, a very fancy and very catchy name, isn't it? So this is basically an artificial index created by wisdom tree. Okay, so they are the ETF provider. Again, this is a strategy based ETF which I avoid now. It's not because I have a fixed mindset to avoid this, but let me tell you that I've been an investor for over 15 years, and if you want to know more about it, then please do comment in the comments box below, and I will create a separate video about how this quality value momentum strategy works. Now, GBDV, that is a global dividend aristocrats index, is basically a standard index. So in aristocrat, the name means they basically invest in those companies which have increased their dividend payout every year. So let me tell you this index is also looks good on the paper, but their total expense ratio is 0.45, which is very high, to be honest. And as per my criteria, if you follow my previous video, then I would never invest in any type of ETF which has an expense ratio of over 0.25 percentage. Again, I prefer to do the whole analysis on the just ETF platform. So I usually go with the 5 key parameters, okay, and which I've discussed at length in my previous video. So if you haven't watched that video, then I'll put a link in the description box, and please do watch that video where I've analyzed in depth. Once I compare those on the just ETF platform, then I create my own strategy, and I've highlighted few strategies here, which you can see on the screen. So you can pick your own strategy here. So the strategy A is the 3 fund portfolio. Ideally speaking, 1 ETF for the country specific, the country which you believe in. Okay. The second ETF could be for all world, okay, averaging out and balancing. And the third ETF could be either gold, REIT, bond, or crypto, which, to be honest with you, I won't put more than 5% allocation of my total allocation. And the strategy B is 2 fund portfolio, one for the total world exposure, 1 ETF for total developed market, such as VHVG, and the emerging market, which is VHEG. Okay, and that's how you can basically have the exposure of world's largest and the mid-sized companies. And the strategy C, which is more like a defensive strategy. So here you can choose 2 fund portfolio. Okay, so one for the equity growth and the second is debt growth. Okay, so just to balance it out, so sometimes people do prefer to use 60-40 ratio, so 60% equity, 40% into debt. Okay, so the equity could be the all world ETF such as VWRP or an equivalent, and the total world bond market, that could be another one for for debt mix. In fact, ideally speaking, you should choose your own country's bond ETF, because that's how you invest into your own country's currency, and that's how you can get the tax advantage. So this is just a rough idea how you can do that. Okay, and similar strategies are also available on Vanguard's platform, which I'm not going to talk about. And if you would want me, then I can create a further video on that. And the strategy D, and that is 1 fund total equity portfolio, such as just investing into one market, such as American market, S&P 500, or Indian market, Nifty 500 or Nifty 50. Okay, UK market such as FTSE 100. Okay, or some people would like to have overall world market such as FTSE all world. Now the strategy E, and that is 1 mutual fund for total world equity. Now you guys might surprise that why the hell you're talking about a mutual fund, but yes, there is 1 mutual fund product available on Vanguard's platform, and the The ticker symbol for that is VAFTGAG, and that is the accumulation version, and they have their distribution version as well. So basically what they do, they are basically buying the large, mid and small companies stocks, more than 7,000 companies, and that is a very good ETF to have for the long term, especially for your SIP account or for your pension accounts. So again, if you want to retire in the next 15 years, then it's always good to have a strategy based on your personal goal and your objectives. Again, this is a mind game, so please do not switch your strategy and try and do not replicate any other strategy. Again, if you're not happy with any of these strategies which I have mentioned here, then you can create your own strategy based on your own due diligence. Okay, and if you don't follow a same strategy, or if you just do in and out ETFs, and if you buy new ETF and then you sell it out, then you won't be able to get the momentum and you won't have a good returns in the long term. So if you want to build a 3 ETF portfolio for the long term investing, then please do watch this video next. And this is Dhaval Bhatt. Thank you for listening. Signing off.